Hello all, welcome to this new Energy Scan webinar session. We are going to wait 1 minute to let more people coming in. So welcome to those who just joined. It's now time to launch the second thematic webinar session of 2025. I'm Julien Waro. I'm in charge of the economic research team here at NG Global Energy Management and Sales. And on top of our usual energy outlook webinars, we decided this year to organize several thematic sessions to focus on specific energy topics. And after the EU ETS2 in February, today we'll focus on the geopolitical context, and especially the first 100 days of Donald Trump at the White House and their impacts on the global economy as well as oil and gas markets. So in this session, I will be joined by Olivier Gasnier for macroeconomy and crude oil topics, and Évariste Nuki for natural gas and LNG issues. So as usual, check out the buttons on the bottom right corner of your screen to ask questions to our speakers or chat with participants, and also leave suggestions to the team. We'll do a Q&A session at the end of each presentation. And I remind you that this session will last 1 hour. Finally, you will also be asked to fill a one question satisfaction survey at the end of the session. The slides and the replay of the session will be available by tomorrow at the latest on the EnergyCan platform, but you can already download them by following the instructions displayed here. So you just have to click on apps, then handouts, and you should see the slide pack here. Before we start the session, I would like to thank you all for your trust and your votes at the Energy Risk rankings. As a reminder, Energy Risk is a reference publication for energy markets, which organizes each year a ranking of energy trading and energy market intelligence companies. And NG and EnergyCan have reached once again very good rankings, notably in natural gas research, where we have been ranked first for the second year in a row, and in the overall research category, where we have been ranked second for the first time among well-known institutions and market intelligence players. So this is a great recognition of our expertise and the work of the EnergyCan team. So thank you all again for your support. So it's now time to move on to the first part of this presentation with Olivier. But let's start with a one question poll first to link with this busy geopolitical news. So regarding, of course, the trade war and the tariff imposed by Donald Trump since the beginning of the month, do you think that the US economy will enter a recession in 2025 or 2026? So thank you for your votes. We can see that there is a majority of the audience in favor of a potential recession in the US in the coming quarters. So that's really interesting. So clearly, the impact of this tariff is expected to be significant. So Olivier, I think you will go into details about that. And so the poll is closed, so we can start. Thank you, Olivier.
Thank you, Julien. Hello, everybody. Thanks for joining us this morning. So, yeah, we'll start by discussing the macroeconomic environment, which is really completely dominated, I would say, the economic environment by since the 20th of January, the inauguration of Mr. Trump by the trade war question. Everybody was, expecting something rather close to the first mandate of Mr. Trump, with a focus on the new tax cut, etc. But he had insisted before that this time it would be more about the rebalancing of the external trade of the US, and so trade war was really on the agenda. That really started on the 2nd of April, after he had announced already some measures. But it was called, the Liberation Day for the US. And I think you remember all this image of Mr. Trump with his table showing the tariffs applied by other countries to US products, and so what the US what would be the answer of the US, the tariffs that they would apply to all imports of goods from this date. Well, I just want to change the. I think it's okay now. Okay, yes. So I have really proposed here a very short version of these tariffs. So if you remember, there was a first announcement with 34% on Chinese goods, 20% on imports from Europe, close to 50% for very small countries, Asian countries in particular, Vietnam, Cambodia, and some other ridiculous examples of small islands being taxed because their surplus with the US was quite elevated. Sometimes because they exported just one product. So the reaction of everybody, the markets, the businesses, was very negative, and that led to tensions on market. We'll see that a bit more in detail after. But that led to the 9th of April, where Mr. Trump finally backtracked and decided to reduce for 3 months, opening a period of negotiations, the tariffs to 10%, which is a minimum for all countries, except for China, for which they imposed 50% more, and then it increased up to 145%. There have been some concession. The case of Mexico and Canada is suspended for the time being. There have been also some pressure coming from tech companies that led to the decision to exclude smartphone and imports of smartphone or other consumer electronics from these very big tariffs. But also you had previously some decision concerning steel and aluminium with 25% tariffs, also special tariffs imposed to all countries buying oil from Venezuela. So this is a mix of geopolitical constraints on the trade war, and these 25% tariffs on foreign-made auto imports. That has been reduced, or not this measure, but the US car makers will not have to pay on top of that the 25% tariffs on imports of steel and aluminium that has been decided yesterday. Of course, the other countries, for most of them, decided to suspend their retaliatory measures for the 3 months period as well. So for the time being, except China, that has increased the tariffs up to 125%. And they have also restricted rare earth exports to the US, which is, of course, a big problem for tech companies. So basically, you have now a situation where you have negotiations between the US and other countries. If you listen to the US administration, it goes well, and it will produce incredible deals, etc. If you listen to the others, it's not the same story. For example, negotiation with Japan have been suspended because, according to the Japanese authorities, they don't know, the US authorities don't know exactly what they want. This is exactly what they said. And apart from that, you have really a trade war between the US and China, with on the one hand 145% on Chinese on imports from China, on 125% on imports, Chinese imports of US products. So this is clearly a situation that is negative for everybody. And you can ask yourself why things didn't happen really as it was expected to happen from the US point of view. If you look at the numbers, you can say that, okay, the Chinese exports towards the US represent close to 3% of GDP. US exports to China is only 0.5% of US GDP. So apparently, China has much more to lose because China has a close to a $300 billion surplus with the US. This is the figure of 2024. So why China is resisting? Why they don't come to the negotiation table? Why do they ask the US administration first to cancel all these tariffs before envisaging the negotiations? I think one of the answers is that the importance of China has taken since its adhesion to the World Trade Organization, so 25 years ago. If you compare, if you take the same map as the one that is represented here, 25 years ago, the map was blue. It meant that for almost every country in the world, the US were the main trading partner compared to China. Not necessarily the main trading partner, but it was a more important trading partner than China. If you look at the situation in 2024, apart from the neighbors of the US and most of the European countries, and also the north of South America, the situation has completely reversed. Now, the world trade is completely dominated by China. And in a way, what we see is that it's much easier for China to replace US goods that are imported in China than for the US to replace Chinese goods, because on top of the consumer goods that are imported, Chinese goods are really included in a supply chain, and the imports of Chinese goods are absolutely vital for many US industries. So this is why also the US has failed, the US administration, the Trump administration has failed to bring all the countries together against China, because for most of the countries, it's the same situation. They need Chinese imports. It's difficult to change completely from, in just a few weeks or a few months, this situation. It will completely broke their industry. And so the dominant situation of China is key to understand why the China is really resisting to the US pressure. All in all, if you look at the average effective tariff rate right now, so taking into account the fact that the US has posed the higher tariffs on all other countries except China, you can see that there are, nevertheless, this situation has not been seen since the start of the previous century. It's even higher than the period of the 1930s, which was really shown as an example of a surge in protectionism. We are close to an average level of tariffs of 30%, 28%. And of course, if there are higher tariffs after the period of negotiations, that could be again higher. There are also measures of global trade policy uncertainty that have really surged, in proportion unseen before. If you compare, for example, to what happened during the first Trump mandate when they launched a mini trade war against China, it was completely different. So you have, on the one hand, the problem of the quantitative problem of higher taxation on trade, and also the problem of uncertainty, because the rules have changed constantly with new announcements. Things have calmed down a bit, but that has been completely unmanageable for companies. What will be the main victim of this war? I think everybody. Clearly, everybody will be a victim of this trade war. It will have a negative impact on global growth, and so far it's difficult to have a clear view because you have no evidence. You have only evidence of acceleration in imports, for example, in the US, or exports in other countries before the start of the trade war in April. So you have figures for the first quarter, for March, etc., but nothing really concrete at this stage, apart from some information concerning really the negative impact of trade war. Nevertheless, you can see on those graphs that consumer confidence has started to react essentially in the US. With, you have two main surveys, the University of Michigan survey and the Conference Board survey that was released yesterday. They both show the same thing, really a collapse in confidence, in consumer confidence that has not been seen since the great financial crisis, with a surge in inflation expectations. And also a surge in fears of unemployment, which is partly linked to the consequences of the trade war, and also partly linked to the consequences of the action of the Doge, led by Elon Musk inside the US administration. That has also some impact on private activity. On the business side, it's not that clear. If you look at the latest PMIs, the Purchasing Manager Indices, well, you have no clear evolution, except in the UK for a reason that I ignore, to be completely honest. If you look at the surveys in Germany, IFO, in France, the INSEE survey, for example, it's about the same. I think it can be probably explained by the fact that you have this uncertainty first, but also a general thinking that the reason will prevail in a way that things cannot continue like that, and the US will backtrack, etc. This is also what supports, for example, the optimism of US markets on the equity side right now. The feeling that things will go smoother on there are tensions, etc. But that will all this will improve, and at the end of the day, the impact will be rather limited. Well, nevertheless, we have, of course, changed our forecast. The IMF has done the same. I have put our forecast, so GMA, and the IMF, the new IMF forecast. The IMF forecast, they have been reduced more or less by half a point in terms of global growth. You can see that it's a bit higher than our own forecast. The main difference is about the US. They have kept of course, they envisage a negative impact on the US economy, but they still keep a 1.7, 1.8% GDP growth forecast for the US in 25-26, which I think is rather high. I think we can seriously envisage a recession, as you have answered the question just before this presentation. And this is why I have a much lower forecast. For China, the impact should be negative as well. And I think also the difference with the IMF forecast is that the IMF seems to say, okay, there will be a shock in 25, but after that we will have a recovery as soon as 26. Well, that seems unlikely unless you have really a big change in US and Chinese relation before that. So the uncertainty is quite high. For the euro area, I think you can say in a way that the negative impact of trade war should more or less offset the positive impact of the change in the German fiscal policy, the increase in the defense effort, all those things that had led to an upward revision in forecast for the euro area next year. So for the time being, this is more or less, the two things concerning each other. As you can see on the graph, so far, those kinds of scenario, even ours, are quite moderate. I mean, okay, we envisage that the US should experience a short period of recession. But if you compare this, of course, to the COVID, okay, let's this aside, or to the Greek financial crisis, for example, for Europe, if you compare that to even the sovereign debt crisis that followed the Greek financial crisis, we are not in the same situation, or not. We have not envisaged such a negative scenario so far. But again, the uncertainty is very, very high. All this to say that you can be positive, saying, well, it's not that serious, or you can say, well, okay, precisely, things could be far worse than what is presented here. In terms of inflation, I think for the time being, as there is no retaliatory measures in Europe, for example, you can say that the impact on inflation will be mostly felt in the US, and this is why we have increased our forecast, and we expect the inflation to jump maybe above 4% again in the US due to the sharp increase in import prices. For China, this is, in a way, this is not bad news, as they fight deflation actually. So a bit higher prices is not that bad. In Europe, actually, you could even have a deflationary impact in the sense that you will have probably more competition coming from China or Asian countries trying to find other places to sell their goods because the US market is virtually closed with such a high level of taxation on their exports, and so this is something that we'll have to check. Okay, so a word on on financial markets. So as I told you, equity markets, they look, they have suffered a lot during the announcement during the Liberation Day, and they have recovered since then. And finally, the correction is rather limited right now. There is an underperformance of the US markets, but they had outperformed previously, and so it's not that big. I mean, for example, for the time being, you can say that the equity market is rather fine. I'm not sure it's a positive conclusion, because you can really expect some further downward correction if when you see evidence of the negative impact of trade war. On the other hand, you have seen, nevertheless, risk aversion increasing sharply, and that has led to huge purchases of gold, and we have seen the price of gold surging higher. I would like to insist, because I think time is running and I'm late, as usual. I'd like to say a word about the bond market that has been important. Well, on the graph on the left, you have expectations regarding the Fed and the ECB policy. So in a way that shows that the impact of trade war has been taken into account, more negative for the US, or more rate cuts for the Fed than for the ECB. Between 3 and 4 rate cut by the end of this year for the Fed expected. So the market, they think that inflation could surge, but that won't be a lasting problem. The problem is really a recession, really be a recession. For the ECB, it's more moderate. On the right side of the slide, you have a graph showing the evolution of 10-year bond yields. It's a bit complicated because you have several effects on the bond market. You have the fact that US inflation should increase. You have the fact that a recession may come, so opposite effects, and you have also the fact that when things turn ugly in general, the safe even asset is really the US Treasury bond, and in particular the 10-year Treasury bond. What has been especially interesting during since the start of April is that we had 2 episodes of sharp tensions in US bond yields, while at that time you should have observed rather a fall in bond yields. And you can see for the very recent period that indeed bond yields have fallen because the markets are more confident. They see some concession by the US administration and they feel that maybe things will improve. The first surge in bond yields was clearly after the announcement of the 2nd of April. And the second episode was about criticism addressed by Donald Trump to Jerome Powell, the head of the Fed, saying very clearly that he would like to remove him and that it would be easy for him, even if it's not, it's in theory not possible. And so it was a warning set by the US bond market to the Trump administration. Investors are losing confidence. The US Treasury bonds are not even the safe even assets that they used to be. That is very important for, of course, for the next steps. Another evidence of that is that despite the fact that you had a widening again of the bond spreads between the US and Europe, with US bond yields surging higher, and this widening of bond spreads should have benefited the dollar. The dollar has really, really weakened since the start of the year. When Mr. Trump came to power, 20th of January, the euro dollar was close to 102. Now it's close to 114. This is a huge weakening, and you can see the evolution of the trade-weighted indices, or the evolution of currency against all other currencies. US dollar falling, Chinese currency following, because of course this is managed by Chinese authorities, and the alternative safe havens such as the Swiss franc, the Japanese yen, and even the euro climbing higher. I don't know if I have time to say a word about oil prices. I will be extremely brief, I promise. Just to say that we have seen really a sharp fall in the oil prices after the 2nd of April. 2nd of April, you had Brent prices just above $75 per barrel. Now we are at 63. And we have even seen the Brent prices falling intraday to 58 at the worst of the crisis before the 9th of April. So first reason, you expect global growth to diminish sharply and global demand for oil to diminish sharply. This has been worsened by OPEC Plus itself. Why? Because they have decided to accelerate the pace of the increase of their oil output on while, because Saudi Arabia has completely changed of strategy. They have decided to abandon their ambition to support prices, and they have decided to regain market share and to make unprofitable many productions, such as, for example, the US shale oil. So in terms of forecast, it's quite easy. I mean, you change of world from one quarter to another. If you look at the line on stocks, you can see that the market was more or less balanced in Q1, and from Q2 it will become really oversupply, and that should even worsen probably till the beginning of next year. So this is why we think that the oil prices could continue to fall, and probably, I mean, given the fact that markets often overreact, you could really envisage lower prices than the prices that are shown on this slide. I'm sorry, I have been a bit too long, Julien. I don't know if we have some question or if.
Yeah, maybe just at least one question. Yeah, rebounding on your last sentence about potentially lower crude oil prices in the coming weeks and months. What could be the impact on the US shale oil industry? Notably, if you remember the famous sentence "drill baby drill" by Donald Trump during his campaign. Is it possible in this
Yes,
context?
this was clearly. I mean, I think it has been. Yeah, I mean, I put this. I mean, on you know. Yeah, if you look at the top of the graphs, yes, Trump inauguration. That, I mean, there was talks about trade war, but also he insisted on the fact that he declared, an energy emergency in the U.S., and so it was absolutely vital to increase U.S. oil output. But I mean, we had a recent survey from the Dallas Fed that showed that for most of the producers, the start of new production sites in the US would require a minimum level of prices of, for the TI, which is lower than the Brent, of $65 per barrel. And given the size, the uncertainty surrounding the economic environment, most of them said at less than $75 per barrel, we won't produce more. So we are really far from that, and probably we could even see a decline in the US shale oil production if prices continue to weaken.
All right. Thank you, Olivier. It's now time to move on to the natural gas and LNG section with Évariste, and we will start with a one-question poll once again on the European market, and classical question for European gas market players is the level of gas stocks at the end of the ongoing injection period. And Évariste, we enter into details, but this has been one of the key topic of the past few months, especially regarding filling targets. So what will be the fullness rate according to you at the end of October? And just remember that the historical fullness rate on average is at 90% at the end of October. So thank you for your votes, and we see small majority between 80 and 90%, so below the historical average. One third, almost of the answer, between 70 and 80%, which is quite low, clearly, regarding the historical trend. And finally, a small number of people believing in a target close to what we had over the past 2 years, with stocks filled close to 100% rate before the heating season. So that's really interesting. some risk still emerging in this market. Varist, I think you have some comments on that, so the floor is yours.
Thank you, Julien. Hello, everybody. So I tend to agree with the small majority with stocks between 80 and 90. So before talking about the impact of US tariffs on the gas market, let's start with the usual European gas balance. Just to say that at the end of last year, the balance was rather tight, as you can see it when you look at the trend in stock levels. You can look at the last row of the table with a huge storage deficit. And the storage deficit widened in Jan and Feb before stabilizing a little. So what is clearly tightening the balance is the increase in demand. When you look at the last column, you see the increase in demand for local distribution zone, residential, commercial mainly, and also for power generation. So this is where we are when you look at stocks here. Not so comfortable, but not so bad as well if you compare them to the world situation of 2022. Since April 9, we are in the net injection period, so stocks are feeling well. We don't expect the deficit compared to last year to be reduced. I believe we still have a deficit. Probably, as I said, we could be at the end of the injection period between 80 and 90%. It is important to note that Europe is well aware that filling stocks will be challenging this year. So although the European Commission has proposed to extend the storage regulation for additional 2 years, they are also introducing some flexibility measure in the way we should reach these levels. So one measure that is clearly under the table and should be adopted is, instead of having stocks filled by 1st of November, which is the current regulation, they could be filled anytime between 1st of October and 1st of December. Clearly, this should help reduce the pressure, the upward pressure during the summer. Some words about Russian gas. In past weeks and months, let us say since Donald Trump came to presidency, there was a lot of hopes, even say speculation, about resumption of the stop Russian gas flows. Here in the graph, I show historical Russian flows, the flows via Ukraine, of course, but also the one via Poland with the Yamal pipeline, the Nord Stream 1. The two are now stopped, and the only one that was still flowing was clearly via Ukraine and Nord Stream. Since the beginning of the year, no flow via Ukraine. We only receive a flow via the Nord Stream pipeline. And this is our central scenario to say that in the very short term, we don't expect additional Russian flows. So the stop flows will remain stopped. And when you listen what the European Commission is saying, here I put the comments made by the President of the Commission, Ursula von der Leyen, last week. She clearly said that the Commission is still working on a project to phase out Russian gas. And the Commission even intends to help the companies that still have some Russian contracts to get rid of the contracts without penalties. So this is for pipeline flows. It is important to note that the European Commission and European officials, they didn't retain, they exclude the idea of banning Russian LNG, just because most European countries are against this measure. And on top of that, I believe that the European officials don't want to surrender their negotiating power compared to the United States. So there are some debate. So Europe estimate that still having the option to continue to import Russian gas could be useful in face of the United States. What does it mean? It just means that yes, you can get rid of pipeline gas, but you continue to import LNG, either Russian LNG or US LNG. At the end, Europe, we know that now it for sure, will continue to need important LNG volumes. That's why for European buyers, it is more and more important to monitor what is happening on the LNG side. So here you have the recent trend in LNG supply. First from the United States, you see the strong increase because the US they put on stream some new liquefaction capacity, particularly black mine. So strong increase translating on the graph on the right into a strong increase in total flows. But note that way, and it is clear when you look at the graph on the right, there is a seasonality in LNG supply because now, 1st of May, we should start to see some plant entering maintenance, meaning that in the very short term, we could see a drop in LNG supply because of those maintenance works. So this is for supply. Now, when you look at imports, what is clear from this graph is, particularly the one on the right, is the drop in Europe LNG imports. Just because of the drop in European prices, particularly TTF prices, Europe is losing competitiveness, attractiveness, let us say, compared to the other import markets, particularly Asia. Because when you look at the graph on the left, Asia LNG imports, they are rather resilient. So this is not worrying yet for Europe, but don't forget that stocks are very weak. So if you continue to see a drop in LNG imports in Europe, at the end, this should not help to reach the famous target storage filling target we expect at the end of the injection period. So to be monitored very closely for the short-term view. But what is now at stake for Europe is not only what is happening in the very short term, it is also what should happen, what could happen in the near future. We can skip that one, just this is show you the competitiveness. What could happen in the near future because of US tariffs? So since the decision by Donald Trump, it appears that most Asian countries, and of course, you exclude China in those countries, most Asian countries, they intend to use gas purchases, let us say energy purchases, but more importantly, gas purchases, to reduce the trade imbalance with the United States and escape high reciprocal tariffs. You know, in the famous formula given by the Trump administration, if you can reduce the trade imbalance, of course, by reducing your export to the US, but I believe that this is not the US wants when you think about inflation. But what they want more is that countries import more from the United States. So importing more LNG clearly is what is on the table. But to do that, you should have some room of maneuver. That's why here we put some graph to illustrate how it could be challenging for some countries to import more US LNG. We do it for Japan, South Korea, India, and Taiwan, which are the main LNG importers when you add China, of course. So the relationship between the GDP growth and energy consumption growth, primary energy, of course, is not perfect, but it is still meaningful. For the 4 countries, when you look at the purple line, which is GDP growth, you compare it to total primary energy consumption, the blue line, you see clearly the correlation. And for some countries, let's take India, for instance, on bottom left, the correlation is even very strong. India is still a developing country, and In economic theory, we know that for the developing countries at the early stage of development, there is a strong correlation between the two. And then the more the economic growth, meaning that services develop, the more you reduce the link between energy consumption and GDP growth. And you can add to that the impact of energy efficiency. That makes for every GDP point of GDP, you don't need a lot of energy because you manage to be much more efficient in your energy use. So having said that, you can then look at the gas complex. Here you put the numbers both for gas consumption and LNG consumption. It is important to note that for some countries, let's take Japan on top left, gas consumption and LNG consumption is increasing less than primary energy consumption. Just because Japan is a mature country for gas. So the room to increase gas demand and LNG demand for Japan is quite small. Just below, when you look at India, you could have room because India is still using a lot of coal in its primary energy balance. But for India, which is, as I say, a developing country, the cost of energy is very important to support economic growth. So India preferred to continue to use coal instead of LNG. India just come on the LNG market when prices are very low. And you see clearly that in 2022, when prices were very high, gas consumption, the green line drop, and LNG imports drop even more. On the right, you have the two countries where you could have additional room to increase LNG consumption. You see clearly that both for South Korea and Taiwan, the growth in gas and LNG demand tend to be above the growth in primary energy consumption, meaning that gas is earning market share in the energy complex. So those countries, I think they could accept to buy more US LNG. And when you look at what is currently happening, it is exactly the two countries that for now have decided to buy more. The first is South Korea. This is buying on existing US LNG volumes. South Korea have some contract with Qatar that are expiring, and they intend to replace them by contracting for US LNG. And recently, a South Korean think tank made some calculation showing that if they do that, if they buy these 9.7 BCM of US LNG, they could reduce the current reciprocal tariff stated at 25% to 23.6%. So this is for existing US volumes. And what I put on the comment is that this is rather bullish for the market because the United States are currently the main providers of flexible spot volumes. If you start to contract those volumes, it means that they will not be on the market. And Qatar is not a major player on the spot market. So you will not see the volumes from Qatar on the spot at the same levels as the US volume. But there are also some options to have a bearish impact. I put here the example of Alaska LNG, a very expensive project in terms of capex, but with a rather competitive total delivered cost. The capex is high because they need to build a pipeline. There is also a carbon capture component. So high in capex, but weak in total delivery cost because the feed gas cost is weak. We're talking about $1.5 per MMBTU. For other US projects, the existing one, you can take Sabine Pass and the other projects that are in Sabine Pass in Louisiana, the others that are in Texas, you can have rather similar cost, total cost, but for those projects, half of the cost is the feed gas because they have to pay the entry up cost. So Taiwan has room of maneuver, and recently they decided to participate in the Alaska project, even as a shareholder. And the US administration told us recently that they intend to organize a meeting early June in Alaska, where they expect that Japan and South Korea will also commit to participate in the Alaska LNG project. So projects are there, but is the feed gas there? So on the left, I put a graph coming from the International Energy Agency. The idea is to say you have liquefaction capacity, but then from liquefaction to production, you can have a delta. The delta is coming from the maintenance. This is a physical asset. You need planned maintenance works. You can have also some outages, but what is much more important and is at stake is the fact that because of feed gas, you can have LNG plants running below capacity. Feed gas problems have been clearly challenging for some countries recently. I mentioned here Indonesia, Algeria, Egypt, and some of them, Egypt even turned from being a net LNG exporter to being now a net LNG importer because domestic production is not as high as before, and domestic consumption is structurally increasing, particularly for power generation. This is not yet the case for the United States. When you look at on the right-hand part of the slide, the United States production is still increasing, but when you look at the trend, we are now below the huge increase we used to have in 2022, 2023. At a time, demand continues to increase, particularly for power generation. Last year, gas demand in the US for residential, commercial, or even industry was down, but gas for power generation was increasing by more than 4%. And at the end, total gas demand was increasing. So you cannot exclude at some point to see a tightening of the US gas balance. And note that some are already complaining, some customers, of course, in the US are already complaining because of this surge in LNG export that are tightening the balance and increasing Henry prices. So this one we can maybe go quick. These are the usual graph. You know it quite well now. But just to point one thing probably is just look at the bullish trend that started in Feb and early March. At the time, the market was so low that in the US, some producers were saying that because of low prices and oversupply, they will start to cut supply. So this is important when you look at now the price drop. Prices are falling. Probably we are not yet at the point where some US producers will start to cut, but it could come. And as I said, the other factor is clearly what could happen now on the consumption side. That's why we are not so sure that prices could continue to fall. And to show that, you can go to the balance. This balance, again, you know it. We tend to forecast what could be stock levels at the end of the year, taking some assumptions. As I say, we don't expect Russian pipeline gas to restart, meaning that we maintain the flows at around 16 BCM. These are flows via the Tariffs pipeline. And then you have the table on the right, which gives the outcomes in terms of stock levels. What is changing currently, what changed compared to what we forecast, let us say, some months ago, is the current trade war. But first, we don't expect the trade war to be worldwide. Yes, you can have a trade war between the United States and China, but as I mentioned, some countries are trying to avoid high tariffs by entering between negotiation with the United States. So yes, there is still a hope to escape the worldwide trade war. And even if that trade war was to global trade war was to happen, we are not so sure that it will have a major impact on demand. When you look at the table on demand, what we can just say, okay, Julia, I know I will try to be quick now. So what we can just say is that this will switch our demand scenario. Instead of being in the central scenario, scenario 2, demand could be weaker because of the drop. The drop should be moderate just because total gas demand doesn't totally depend on the economic situation. You have demand for power generation, for heating, for cooling, which are weather dependent. Even demand for power generation could be weather dependent because of wind and solar generation. So at the end, the impact should not be so significant. This is true for Europe. This is true as well for Asia, meaning that yes, if Asian demand continue to weaken, you can have additional Asian LNG demand destruction, and those volumes could come to Europe. So what changed in our view is that we just switch from scenario 2 to scenario 3, the market being a little bit more comfortable. These are flows gas stocks at the end of the year, which could be rather similar to a scenario where you should be around 80% and 90% full by the end of the injection period. So the last comment on the slide is also important because recently, it was on last Monday, US Energy Secretary said that he hopes that Europe will increase the offtakes of US LNG, and there are currently discussions about contracts. What does it mean? What is happening with Asian buyers? The US will try to do it with European buyers to encourage them to contract for US LNG. So let's move to the last slide about the price trend. When you look at the price for this year, they are very close to Brent prices. As a reminder, Brent is very important. The oil price is very important for the gas market. As a simple rule is to say that when the gas market is very tight, gas prices tend to trade above Brent prices, and when you are very comfortable, you tend to trade below. You see that for the remainder of this year, we are trading close to Brent prices, clearly in an equilibrium period where you don't know if you are tight enough or comfortable enough. This could last for some time, but just keep in mind that talking with Olivier, he say, okay, Brent prices could drop. They can drop to low at 50, 55. If this happens, it means that in euro per megawatt hour, you could drop to 28. To me, given the current price level, this downside is rather moderate. And even you assume that Brent prices will drop. Don't forget, and this is the idea that was behind the question asked on the macro and oil part. If oil prices continue to drop, at some point you could have a drop, a production reaction, a drop in oil production, ending also in a drop in gas production, at least the associated gas production. So limited downside potential and the upside potential, to me, it is much more important. Of course, I did not put it on the slide, but this is for this year. From next year, given what we expect in terms of LNG supply, of course, you could have downward pressure on prices, pushing them below Brent prices. But as I say, we have to be careful. The balance could be less oversupply than what we expect, and the spread between oil and gas could be weaker than expected. So I'm done, Julien. Sorry, I'm a little bit long. Do you have some questions for me?
Yeah. Yes. Thank you. Thank you, Évariste. Thank you all for your attention. So I'm just gonna launch the one question satisfaction survey at the same time that we will take question. So if you can just take a few seconds to answer the satisfaction survey. That will be very, very important for us to have your feedback. So yeah, a question especially regarding the storage targets. We have several questions in the chat. So there is a question regarding the okay, are they really relevant as there is no penalty behind those filling targets if they are not reached?
They are relevant because they give a target. They set to give a target in a way to a kind of benchmark. But it is important that they are not so binding, because don't forget that in 2022 it was because people were forced to try to fill the stocks at the asked target that we reach such high levels. So to me, it is important that the European Commission recognize that in very tight market conditions, it is important to be much more flexible.
And do you think that these targets could be reduced from the initial level set at 90%?
I mentioned the US gas balance, showing that during the summer, for instance, you can have this demand for power generation and so on. I hope that if tomorrow it happened that the US gas balance tighten because of stronger demand or lower production, and the US is not able to send a lot of LNG to Europe, I hope that the European officials will accept to say, okay, we cannot reach the target, and then you can lower it. I don't know what they will do, but if I was in their shoes, it's what I would do.
All right. Thank you, Evariste. Thank you all for your attention, for your questions. So we will take some time to answer the questions by email for the questions we did not take during the session. So the next session will take place in June, and it's no time to close to close this session. So I hope you enjoyed it. And so see you soon on Energican, where you will find the slides and the replay of the session. Goodbye.
Bye-bye.
Bye.